Welcome to World Knowledge. China, a country facing a deep economic crisis. After decades of strong economic growth, China is now facing serious challenges due to a decline in GDP growth, financial instability, and fluctuations in the real estate market. These problems not only affect the domestic economy but also have a profound impact on the global economy. So what is the cause of this situation, and what policies or measures are being implemented to respond to the crisis? We will explore important aspects of the current economic situation in China. According to Time, China's growth rate is slowing down with a growing mountain of unsustainable debt, pushing the debt-to-GDP ratio to a record 288% by 2023. Worse, much of the borrowing has been used to buy assets that no longer generate enough income to repay the debt, especially in the real estate sector. Home sales in China have fallen by a third and new construction is down 60% from its pre-pandemic peak. It is one of the world's worst housing crises in 3 decades. Experts say the current situation in China is quite similar to the cyclical debt crises that have plagued capitalist countries throughout history, most notably Japan's crisis in 1989 when a ballooning debt bubble ended decades of high growth and soaring asset prices in the land of the rising sun. We can see that Japan's Nikkei stock index peaked in late 1989 and fell nearly 80% over the next 13 years. Real estate prices fell for 2 decades starting in 1991. Since then, both major asset classes have not exceeded their pre-crisis peaks. Japan went from being the fastest-growing major economy from 1954 to 1973, often growing at over 10% per year, to being the slowest, with an average growth rate of just 1.75% per year from 1981 to 2023. And China could face similar persistent difficulties as Japan. China's astonishing rise was fueled by an even larger debt buildup than Japan's following the market-oriented, modernizations of the late 1970s. Like Japan during its post-war economic miracle, China's growth was driven by an export and real estate boom. In less than half a century, China went from a poor centrally planned economy with limited international trade to the world's leading exporter and second only to the United States in the number of billionaires. As we know, and as Time reported, the bubble and the rapid increase in debt create opposing interests. Chinese real estate developers want to borrow more and more against their projects, so real estate prices continue to rise. However, the bearish lenders, mostly big banks and bondholders, worry that price inflation will reduce the value of their debt assets. But the bubble is deflating quickly. Chinese lenders have already scaled back new lending and raised interest rates, following the government's 3 red lines policy in 2020. As China's most indebted developers go bankrupt or panic sell to repay loans, asset prices will continue to fall as investors return and buy assets at attractive discounts. This would set a very low floor for prices, collapsing the previous price system and shaking up markets, but also rapidly redistributing wealth from borrowers to creditors. China faces a major challenge as it tries to emerge from recession, as most provincial and local governments have profited and gained prestige by financing large-scale property development. Goldman Sachs economists put the figure at $8.4 trillion, or nearly 50% of GDP. Local governments profit just like any other property developer. But the central government in Beijing is increasingly concerned about the value of the yuan, which hit a 16-year low in September 2023. Beijing has intervened to prevent the Chinese currency from falling too quickly by selling foreign exchange reserves and buying yuan. Despite having abundant foreign exchange reserves, if the real estate boom continues unchecked, these reserves will eventually run out. The economic and real estate policy dilemma in the country of 1 billion people is making it difficult for all parties involved. Rising real estate prices have slowed consumer demand, especially among young people looking to buy their first home. This is one of the reasons why China's marriage and birth rates have recently fallen sharply. Traditional businesses are struggling because of high property costs, which are driving more and more internet-based businesses. On the other hand, falling prices affect all those who buy real estate with mortgages, whether they are homeowners, investors, or businesses. They may fall into a difficult situation when the value of their assets falls below the level of outstanding debt. It can be said that this crisis in China is largely due to the encouragement of private borrowing and lending. When the economy seemed to be overheating, Beijing actually cooled the market with its three red lines policy in August 2020. These credit restrictions were harsh on developers, as many of China's largest real estate companies, as well as millions of individual investors, had overextended themselves. Once prices stabilized and then fell, investor demand dried up. Consumers may have a need to buy property for their own use, but investors and speculators only want to buy if they are confident prices will continue to rise. The slump in Chinese real estate prices is unlikely to end soon, but at least the government can redistribute the losses. Stopping the slump is difficult, in part because of the huge inventory of unsold or under-construction apartments. Estimates of the number of empty apartments, many unfinished, range from 50 million to more than 100 million. Even if no more homes are built, it could take a decade or more to absorb the existing inventory. Beijing has recently tried to keep construction workers employed by encouraging state-owned banks to continue lending to complete construction projects that were halted when developers lost credit. But this policy will increase the supply of unsold apartments, which will exacerbate the decline in prices. If the government is determined to let prices continue to fall until consumers and investors start to believe they are low enough, a floor will be set. But that floor may be too low and sales too small to enable developers and investors to repay the loans they took out to build or buy those apartments, leading to foreclosures and bankruptcies for many apartments. Such a wave of bankruptcies would endanger China's financial system, especially the unregulated, shadow banks that invested heavily in China's housing bubble. Many experts believe that the real cause of China's current economic and real estate downturn is the prolonged period of hot growth that has piled up a lot of vulnerable and unsustainable debt. Therefore, they fear that the higher it flies, the more at risk the economy and real estate market will be of falling hard. Evergrande, one of the country's largest real estate conglomerates, has announced that it cannot pay its huge debts. The group, once a symbol of rapid development and prosperity in the real estate industry, is now on the brink of collapse. The story begins with Evergrande's strong development, as it continuously expanded its real estate projects and borrowed money from many sources to finance its relentless growth. However, the real estate boom led to a glut, and demand for homes began to decline. As the Chinese government tightened credit to control financial risks, Evergrande and many other real estate companies found themselves unable to meet their debt obligations. Despite the group's efforts to tackle its debts, the problem became more serious, raising concerns not only in the real estate industry but also in the broader economy. Investors, creditors, and millions of consumers were affected, leading to a wave of panic and uncertainty. In response, the Chinese government quickly rolled out countermeasures. Several financial support and economic stimulus packages were announced to stabilize the market and support affected companies. In addition, the government focused on promoting domestic consumption and reforming the financial structure, hoping to restore confidence and promote sustainable growth. So how does a Chinese crisis differ from a Western one? It is true that China has never experienced a crisis, the Wall Street panic of 2008. The crisis China is facing is different from all other crises, according to a recent article published by Bloomberg. China's current economic crisis is attracting global attention, especially when compared to Western-style economic crises. Characterized by a sharp decline in GDP growth, instability in the real estate market, and rising public debt, the crisis reflects the unique factors of the Chinese economy. While Western crises are often associated with financial problems such as banking crises and asset bubbles, China's crisis bears the distinct marks of a planned economy and heavy government intervention. Let's explore the key differences between the Chinese and Western crises to better understand the causes and effects of each. Instead of a shock that collapses banks and robs jobs, the Chinese version of the crisis is so long, so persistent, so slow-moving that it's barely noticeable. The amount of money and damage China is suffering is as bad as, or worse than, the crises we might expect. A few years ago, some China watchers, including this author, predicted a 2008-style collapse in the Chinese economy. All the signs were alarming: a real estate bubble, excess capacity in industries from steel to solar panels, most worryingly, rising debt. Total debt as a share of GDP was estimated at 253% in mid-2018, compared to 140% a decade earlier, according to the Bank for International Settlements, BIS. No emerging economy since the 1990s has ever had such a large debt load and avoided financial turmoil. If China can avoid a debt crisis, it will be on the wrong side of history. We keep waiting for a Lehman Brothers-style moment in China, and for more consequences. In the end, it never comes. Many analysts argue that what we imagine will not happen, because China is too big to fail. The Chinese government, the new view asserts, has too many layers of control over banks, large enterprises, capital flows. Enough control to prevent a crisis that a free economy cannot avoid. In 2015, China was in the spotlight when its stock market bubble burst, largely due to credit and bureaucracy. Money flowed out of the country, the yuan fell. What had caused other emerging markets to collapse did not affect China as much. The government bailed out the stock market and stemmed capital outflows. Crisis averted. This approach can be seen as representative of the strategy for solving China's debt problem. The Chinese government, deeply concerned about financial stability, did not allow the debt bomb to explode. However, the crisis, with its purely Chinese characteristics, still had a devastating effect on the Chinese economy. Like any debt crisis, the health of China's banks was severely affected. Although bad debt officially reached a decade high at the end of 2018, it still accounted for less than 2% of total debt, according to the Chinese government. And few people believe this figure. Charlene Chu, a senior research fellow at Autonomous Research and one of the leading experts on China issues, estimates that about 24% of total debt has become non-performing. This is a high rate, but during the 1997 Asian financial crisis, non-performing loans in many economies such as Indonesia, South Korea and Thailand reached the equivalent of 30% of total debt. As in crises, the true scale of debt and losses is much higher than anyone has predicted. In a study published in October 2018 alone, the credit rating agency S&P Global Ratings emphasized that the level of Chinese government debt remains a mystery, with much of it hidden off the balance sheet. Such hidden debt could be many times higher than the actual amount disclosed, estimated at around $6 trillion. S&P calls it a debt iceberg with extremely high credit risks. Local governments have pumped a lot of money into infrastructure development, but when debt is so high, that role is limited. The deep economic crisis that China is experiencing is not only a major challenge for the country's economy but also has far-reaching implications for the global economy. Issues such as slowing growth, financial instability and a slump in the real estate market have pushed China into a difficult period. To overcome this crisis, the Chinese government needs to take strong and comprehensive measures, from economic structural reform to promoting domestic consumption and stabilizing financial markets. Meanwhile, the recovery of the Chinese economy will depend not only on domestic policies but also on the support and cooperation of the international community. We need to continue to monitor and assess future developments to better understand the long-term impact of this crisis and effective solutions to restore stability and sustainable development. Although China's economic crisis and Western-style crises have both caused serious impacts, they are clearly different in their causes and responses. While Western crises are often associated with financial system collapses and asset bubbles, China's crisis is associated with imbalances in growth, real estate markets and public debt. The Chinese government has adopted strong intervention measures and specific economic policies to adjust the situation, which has created different approaches and solutions compared to Western countries. Understanding this difference not only helps us better grasp the current situation but also provides insight into crisis management strategies in different economies. If you find the video useful, and subscribe to the channel, like and have any questions, please leave a comment below. Thank you for watching. Goodbye and see you in the next video.